Richard Hemming here, founder of Under the Radar Report. It's great to be back. The market has been so tumultuous that it's made all our heads spin. I want to give you 3 points to help you manage your portfolio now that valuations have ratcheted back up following the big rebound. So like you, my portfolio has swung about quite a bit, but I'm happy overall because the core holdings have held firm. So my 5 core holdings include Evolution Mining, EVN, Superloop, SLC, which are also the same as Under the Radar's portfolio, and they're up. And I've returned about 26% in the past year. Our house portfolio has been going much longer, is up around 24% a year for the past 2 years. But look, it's been a long road. It has been a long road. We've been managing that portfolio for 13 years, and the portfolio's returns based on stock picking, and that's certainly an art, but included in that art is portfolio management, which is about containing risk, and that's what we're focusing on today. Look, the first point I want to make is, what are we trying to do? We're trying to generate income and growth. So fund managers make their living by trying to beat the index. That's not us. Our advantage is that the index, while not being irrelevant, is something that we can take advantage of. So we're just about making money. So what you can do is invest in some solid dividend paying blue chips and also, dividend paying small caps. Like our small cap dividend portfolios outperform consistently over time, at double-digit rates. Why is that? Because those dividend portfolios are populated by profitable, quality small caps that we purchase at value prices. Check out our small cap dividend portfolios in the special reports section of our website. And the good news is, in the next couple of weeks, we're updating those portfolios. So something to look forward to. On the growth front, you want to be having a bit more fun. Look, I won't deny it. That's the part of the portfolio management process I enjoy the most. Look, the stocks I mentioned above, Evolution and Superloop, they were once growth stocks. When I first looked at those companies, we only put a bit of, small portions of them in our portfolio all those years ago, but they've grown and grown and they've become core. These are return drivers. So it's not that one stock, you just pick a core stock straight off the bat. Many times these companies emerge and become core to the portfolio. You're leveraging into success. So the second point I want to make is that we're trying to protect our portfolio's value. We are trying to protect our capital. That's what we can do very effectively if you follow, certain principles that I'll just talk about in a second. But what we're seeing is pressure on funding. So it's harder for companies to get money. Brookfield wrote off billions of dollars on their Healthscope acquisition because they got too much debt on board. We're seeing in our own portfolio, the dividend yield sort of has halved in the past 12 months. Why is that? Because the companies that we're investing in, they're going for growth with that capital instead of paying out dividends. So what do? Well, you make sure you do your balance sheet analysis. That's what we do. We look at the balance sheet and the cash flow very closely. A lot of the market, like, the brokers and fund managers, they're obsessed with meeting earnings expectations. Well, that is important, but in the long term, your capital is protected by the balance sheet and cash flow, which is where we focus on. The third point I've got to make on portfolio management is there is so much uncertainty that you need cash. Like at the start of the year, we were up at 27, 28% cash in our portfolio. We've been buying. We're now down at 22% cash. See, so our cash weighting, even though we've been buying, is high. Look, does anyone believe that in the 6 weeks since Liberation Day, when they introduced all those tariffs, that things are just hunky-dory? Does anyone believe that? The markets have rebounded. That's one thing. But what you need to keep an eye on is the US 10-year Treasury bond yield. So at the moment, it's around 4.5%. That's at 15-year high levels. So that's at the top of the range over 15 years. So it's certainly something to pay close attention to. So the degree of uncertainty is very, very high, which trumps everything. And it comes back to why you need cash in your portfolio. So read about our portfolio's performance, read about the analysis we put behind it on our website in our last 2 issues. It's really worth your time. But the bonus point, there's always a bonus point. The bonus point is not to do things too big too often. Small steps, I can never emphasize that enough. It's small steps. So don't make big changes. Buy small amounts when you're buying and leverage into success. Similarly, when positions get big in your portfolio, you think about taking profits. It's never wrong to take a profit. It's rarely wrong to take a profit. Remember, we're still following the same actions we would have been following had tariffs never entered the equation. So it's business as usual for us. We're buying slowly, we're looking at the fundamentals, we're sticking to our knitting. We're controlling what we can control. And in that way, over the long term, we'll be all right. So the next couple of weeks, we've got heaps to look forward to. Gold analysis, lithium analysis, dividend portfolios. It's all coming. So happy investing. And don't forget to check out our recent issues. See you next time.